Welcome to Centaur Financial Services Podcast. The information provided on and made available through this video and podcast does not constitute as financial product advice. The information is of a general nature only and does not take into account your individual objectives, financial situation or needs. It should not be used, relied upon, or treated as a substitute for specific professional advice. We recommend that you obtain your own independent professional advice before making any decision in relation to your particular requirements or circumstances.
Hi everyone, welcome to the Centaur Financial Services webinar on our investment series. Talking today to Hugh Selby-Smith, one of our favourites from Talaria Global Equity Fund. What I'm really excited about today is to really unpack how the fund works, how it's going to get through tough times, how it's traditionally got through tough times, so that for you, our clients and investors in this fund, can have a sense of comfort and security that your money's being managed well. And I really honestly feel that after listening to Hugh speak today, we'll tick off that goal. So right now, I'd like to introduce you to Hugh Selby-Smith.
Thanks, Hugh. Great to be here, and obviously honoured to be able to speak to you as your clients and your clients.
Can you please tell us a little bit about Talaria, the fund, how long it's been around, when you started, what your background is, just so that our clients get a real sense of how it came to be?
Yeah, absolutely. So my own personal story, I'm tremendously happy and happily married to Fernanda. So that's probably the number one thing that's going on in my life.
That helps.
I have two children. Bought my first stock and share in 1983. Did the collecting people's letters and cleaning their pools over summer. And my dad had always had some stocks and shares, and it was sort of a bit like the sports pages then. It was like +2, -2, depending on each day. The money that I'd saved then, I went and bought Mount Isa Mines and Repco, and then I looked at Mount Isa Mines from 1983 for about the entire decade, be between 181, 179, 183. So that was sort of my personal journey into investing. In terms of Talaria itself, we only run one strategy. We've had that strategy in place since 2005, and that really is around compounding real wealth over a long period of time. I guess the reason that we exist as a firm is really to give greater certainty to our investors in terms of the financial outcomes, and that then allows them to go and live their life. And that's why we exist as a firm, really. Yeah. In terms of the firm itself, there's 15 people in the business. 7 of us in the investment team, over 125 years of investment experience. We have 5 people who help us in terms of client service and distribution, and then we have the business team. Predominantly we're Melbourne based, we also have a Sydney office. Currently we're running around about 2 billion Australian dollars, and that is non-institutional, all people who are like yourself, so businesses like yourself.
So we've got a global equity fund, and I think there's a couple of interesting points every time we've looked at your fund and talked with you about that we should unpack around the size of the fund and why we don't want it to get too big, or the opportunity set. And then also, why can we then talk about what the actual strategy of the fund is and how you do it, touching on things like how we get the income that we generate, because I think for our retiree clients in particular, having that income is really important, with the same notion that what worked well the last 10 years probably won't work well the next 10 years.
Great. Yeah, I mean, there's a lot in that, obviously. Yeah, I mean, in terms of the firm itself, listen, we're a founder-led business. We are ultimately paid a fee by people like yourselves and your clients. We work on their behalf, okay? And everybody who has trusted us with their hard-won savings is really judging us on that consistency of outcomes that we've been able to deliver over 19 years, and that we're working hard every day to continue to be able to deliver. And I will unpack that, which is really the second part of your question. But we're not going to be the biggest boat in the harbour. We continue to stick to that one strategy, and that's limiting in terms of our size ultimately. And that limitation really comes because of the way that we buy and sell stocks, which drives 3 distinct outcomes, and that's what we're consistently judged by. One, we have a second lever of returns, which is really about how we buy stocks, and this generates strong, stable and consistent income, which is outside the business cycle. Okay, and I feel very strongly about that because dividends, we know, are the vast majority of ultimate long-term compounded returns, and yet they're pretty volatile.
This point on the income during uncertain moments. If I remember correctly, there was a story around the GFC, how much income you were able to generate over that period of time.
Yep.
Can you touch on that?
Yeah, absolutely. Why don't I start with actually what it is that we do,
Yes.
so we can take people on that journey. So we spend all our time looking bottom up as value investors for mispriced securities, okay? And we're trying to really estimate the normalised earnings power of a business. Everything's cyclical, and we're trying to work out the normalised sort of cash return that can come out of the business that potentially we're going to invest in. And that's what really any true to label value manager does, okay? We think we do it very well, but there's a lot of people doing that very well, in all honesty. The point of true differentiation is everybody else of a traditional long-only equity manager would simply go into the market once they've committed to buy that on behalf of their investors and buy the first 1% of the stock. What we do, Hugh, is we sell a put option, fully cash backed and exchange traded. A put option should just be considered as a promise to own a stock in 2 months' time, okay? And that's all we're doing. We're using this to reduce the risk in the portfolio. And in return for making that commitment to buy the share we want to own, we get two things in return. We get a commitment to buy it at a cheaper price than it's trading at today, or a lower price that it's trading at today. But really crucially, and this is your point about the income component, we also get paid what's called a premium. Now the key thing is really in a normal environment, you know, the world goes up, the world goes down, we're generating about 6% per annum just from the premium that we retain. Once uncertainty rises, the cost of committing to buy that share we want to own goes up. Where we buy it goes further down, and how much we're paid goes up. So in 2008, actually, we were making about 1.5% per month in terms of income, which means that over the course of that year, we made about 1,800 basis points of return, so 18% income. Now, clearly, that's tremendously valuable about the ability to pay a consistent income, but also it buttresses the downside. So on the capital component, over the course of the 07 to 09 peak to trough, markets went down about 50%, a little over 50%. Now, we had about $55 per 100 in direct stocks and shares. So say that we added no value on that, say, which is not quite true at all, but say we did that. So that would be down $25. Okay, so you've still got 30 left, but then actually suddenly you've got the other 30 of cash, which is 60, that's also then generated 1,800 or 18% return. So actually then suddenly you're like, okay, well now we're at $80 per 100 and we had some unencumbered cash, so you're actually closer to 90. So instead of suffering the drawdown from 100 down to 50, you're actually at 90.
Yeah.
And the crucial thing about that is the security that gives you over a course of an uncertain period, but then you've got $90 working for you in the ups.
Yes.
And that's the key kind of reason that you want to lose less when the market goes down.
Yes.
Just a few numbers. Over the life of the fund, like I said, we started this strategy in 2005 and we unitized in 2008. Our downside capture, so for every 10% move down, we've captured about 3.4% of that.
So that's the market goes down 10%, your fund goes down 3.4.
Exactly. So instead of being at $90, we're going to be basically at $96.60. And that's a tremendously powerful thing over a long period of time.
And so part of the, I suppose, reason we love the fund so much is that we think about the global financial crisis in the context of how we're building portfolios for retirees. So during that time, if you were getting a really strong income component from your portfolio, it would help you, you're still not going to feel good when you're seeing the market go down and all the volatility, but you're going to get a good income, paid into your cash account that's going to help fund your pension payments, which means that you're not going to need to sell down your portfolio
100%.
at what we know would be the worst possible time. So as a value manager, can you give us a couple of examples of stocks that you've bought, why they're attractive to you, how you, even just quickly touch on how you enter them again, but really just give our guys a feel for what you're looking at and how you're looking at and how you're finding that.
Sure. So why don't I just take you through right at the sort of inception of an idea right through into the portfolio, and I can actually talk about the implementation again on that. So, as I said, everything ex-Australia is our investable universe. It must have a developed market listing. So we have a couple of filters. The first filter is it's got a minimum daily turnover of $30 million US. So that's about a $5 billion market cap is the absolute lowest that we'll look at. That's about 1,800 global securities. Is kind of where we can look for potential ideas. The portfolio itself typically has 25 to 35 ideas, and the average holding period's about 3.5 years.
Which would be high in the industry.
Yes, it's probably one of the most startling things over my career is just the average holding period has just collapsed and collapsed and collapsed. Yeah. You're talking now, single figure months is the average holding period.
That's investors, so big fund managers are buying a investment that's meant to be long term and holding it for a couple of months and selling it again.
They are. Yeah, I think the average holding period in the US equity market now is about 5.5 months.
Wow.
Yeah.
Okay. So they can't really claim they're long-term investors like you guys at 3.5 years.
They can't. They'd have to change the definition of term.
Yeah,
yeah exactly.
Yeah.
Either that or they're living at a very fast pace, I think.
Yes.
So how do we allocate our time? Because that's all we've got in our business, like human capital. We run a screen within sector and within region. So we're not unwittingly creating a sector or country bias. We never sit there and say, consumer staples is a good place to be in this environment. Let's find a consumer staple that fits our valuation criteria, or Switzerland's looking cheap. Let's look for a Swiss stock. So we're looking within sector and within region. We're running a screen. And really the purpose of the screen is simply to get a high hit rate of stocks that outperform by a bigger magnitude. So it's really about where to spend our time.
Yeah.
And through that screening process, everybody in the investment team will get 12 to 14 stocks per month to have a look at. Now, everything we do is through the annual reports and financial statements, and we would then model the nearest 2 to 3 competitors. Because at heart, our process is really, as I said, trying to come up with an estimate of the earnings power of this company in a normalized environment. A lot of ideas would suggest that you're going to get 10% return to an equity holder, and yet we know from history they get 6.
Yes.
And what's that difference? Well, it's things like cash restructuring charges or litigation, remediation, pension plans that have unrealistically high return assumptions. So you want to make sure that, if it looks 10%, it actually is 10% in a realistic 10-year view. So we're doing all that. So let's say that we have a stock in the portfolio currently. A good example would maybe be Roche, Swiss pharmaceutical company, came through the screen. What we would be doing in that environment, for Roche in particular, obviously a lot of the major drugs have large patent protection.
Yes.
So they're legally protected, they have exclusivity, and we're able to model out those largest drugs knowing the patent protection to be able to give us the cash flows. Once they go off patent, that falls 70 or 80%, okay? So then we're saying, okay, here's the value of the cash flows of those major drugs. Let's say, that's worth 400 billion in today's cash. Roche is trading at 300 billion. So then you say, well, that looks cheap, right? But then they're actually spending about 13.5 billion cash R&D spend a year. So you've got to make an assumption about, well, what kind of return are they able to make from that? We have no competitive advantage, Hugh, on stage 3, multiple sclerosis drug is going to be successful or not.
Yes.
Or stage 2, lung cancer treatment is going to yield a commercially viable drug for them. But what we can do is we say, well, okay, we know that there's 400 billion of cash flows in today's money off the existing portfolio. The market's only paying 300 because they're saying you need to find effectively 100 billion of that new science is gap is about 100 billion.
Yes.
So then we've looked at the last 15 years at Roche and said, well, for every dollar spent of R&D, they've generated about 3 times in revenue that they've spent. Yes. So for a whole year, they might spend 13.5 billion and find nothing.
Yes.
Or even 2 years, and they'll find nothing, and that's 27 billion. But actually what the market's saying is that you've effectively got 100 billion of spend that you're not going to find anything on.
Yes.
And we found that that's actually a very good way to look at pharmaceuticals. And so having socialised that, and we'd had a look at the R&D productivity of the global closest peers in oncology, Novartis, Johnson & Johnson. We'd also looked at Sanofi. Once we socialised that in the team, after about 7 weeks of work by my colleague who did that, got comfortable with the assumption, the stock was trading at about 260. So we had the valuation. The stock was trading at about 265. So rather than buy it, as I said, we made a commitment to own Roche at would have been about 260 in that instance, relatively low volatile stock, and we would have been paid in return about $8 of premium.
Yeah.
And that's how ultimately we've become equity owners of Roche, and we've also generated income from all those instances that we've committed to buy Roche because we think it's extremely cheap, where we haven't had that exercised and converted into stock.
So if Roche didn't go down, you then just walk away and take the income.
Yeah, and when we would rewrite it next time.
Yes.
Yeah, exactly.
Yep.
So, I mean, there's plenty of instances in the fund's history where we've generated 50 to 60 basis points of income,
Yes.
but we've never owned the stock
Yeah.
on a single stock where you're just actually rolling it. So in that example, if Roche just stayed at 265 and we kept doing the 260, and we got paid, this $8, $9 or Swiss francs, so, 15% annualized rate of return, effectively, because we never do it at less than that, then you would just sit there forever getting 15% annualized rate of return on whatever capital you committed to that idea.
Yeah. So you like it at 260, you're interested in it at 265, you like it at 260, you love it at 250. So you're actually true to label as a value investor. You are literally buying it as it goes down, down, down.
So, as I said, everything ex-Australia is our investable universe. It must have a developed market listing. So we have a couple of filters. The first filter is it's got a minimum daily turnover of $30 million US. So that's about a $5 billion market cap is the absolute lowest that we'll look at. That's about 1,800 global securities. Yes. Is kind of where we can look for potential ideas. The portfolio itself typically has 25 to 35 ideas, and the average holding period's about 3.5 years.
Which would be high in the industry.
Yes, it's probably one of the most startling things over my career is just the average holding period has just collapsed and collapsed and collapsed. Yeah. You're talking now, single figure months is the average holding period.
That's investors. So big fund managers are buying a investment that's meant to be long term and holding it for a couple of months and selling it again.
They are. Yeah, I think the average holding period in the US equity market now is about 5.5 months.
Wow.
Yeah.
Okay. So they can't really claim they're long term investors like you guys at 3.5 years.
They can't. They'd have to change the definition of term.
Yeah,
yeah exactly. Yeah. Either that or they're living at a very fast pace, I think.
Yes.
So how do we allocate our time? Because that's all we've got in our business, like human capital. We run a screen within sector and within region. So we're not unwittingly creating a sector or country bias. We never sit there and say, consumer staples is a good place to be in this environment. Let's find a consumer staple that fits our valuation criteria, or Switzerland's looking cheap. Let's look for a Swiss stock. So we're looking within sector and within region. We're running a screen. And really the purpose of the screen is simply to get a higher hit rate of stocks that outperform by a bigger magnitude. So it's really about where to spend our time.
Yeah.
And through that screening process, everybody in the investment team will get 12 to 14 stocks per month to have a look at. Now, everything we do is through the annual reports and financial statements, and we would then model the nearest 2 to 3 competitors. Mm-hmm. Because at heart, our process is really, as I said, trying to come up with an estimate of the earnings power of this company in a normalized environment. A lot of ideas would suggest that you're going to get 10% return to an equity holder, and yet we know from history they get 6.
Yes.
And what's that difference? Well, it's things like cash restructuring charges or litigation, remediation, pension plans that have unrealistically high return assumptions. So you want to make sure that, if it looks 10%, it actually is 10% in a realistic 10-year view. So we're doing all that. So let's say that we have a stock in the portfolio currently. A good example would maybe be Roche, Swiss pharmaceutical company, came through the screen. What we would be doing in that environment, for Roche in particular, obviously a lot of the major drugs have large patent protection.
Yes.
So they're legally protected, they have exclusivity, and we're able to model out those largest drugs knowing the patent protection to be able to give us the cash flows. Once they go off patent, that falls 70 or 80%, okay? So then we're saying, okay, here's the value of the cash flows of those major drugs. Let's say, that's worth 400 billion in today's cash. Roche is trading at 300 billion. So then you say, well, that looks cheap, right? But then they're actually spending about 13.5 billion cash R&D spend a year. So you've got to make an assumption about, well, what kind of return are they able to make from that? We have no competitive advantage, Hugh, on stage 3, multiple sclerosis drug is going to be successful or not. Yes. Or stage 2, lung cancer treatment is going to yield a commercially viable drug for them. But what we can do is we say, well, okay, we know that there's 400 billion of cash flows in today's money off the existing portfolio. The market's only paying 300 because they're saying you need to find effectively 100 billion of that. New science is gap is about 100 billion.
Yes.
So then we've looked at the last 15 years at Roche and said, well, for every dollar spent of R&D, they've generated about 3 times in revenue that they've spent. Yes. So for a whole year, they might spend 13.5 billion and find nothing.
Yes.
Or even 2 years, you know, and they'll find nothing, and that's 27 billion. But actually what the market's saying is that you've effectively got 100 billion of spend that you're not going to find anything on.
Yes.
And we found that that's actually a very good way to look at pharmaceuticals. And so having socialised that, and we'd had a look at the R&D productivity of the global closest peers in oncology, Novartis, Johnson & Johnson. We'd also looked at Sanofi. Once we socialised that in the team after about 7 weeks of work by my colleague who did that, got comfortable with the assumption, you know, the stock was trading at about 260. So we had the valuation. The stock was trading at about 265. So rather than buy it, as I said, we made a commitment to own Roche at, would have been about 260 in that instance, relatively low volatile stock. And we would have been paid in return about $8 of premium.
Yeah.
And that's how ultimately we've become equity owners of Roche. And we've also generated income from all those instances that we've committed to buy Roche because we think it's extremely cheap, where we haven't had that exercised and converted into stock.
So if Roche didn't go down, you then just walk away and take the income.
Yeah, and when we would rewrite it next time.
Yes.
Yeah, exactly.
Yep.
So, I mean, there's plenty of instances in the fund's history where we've generated 50 to 60 basis points of income.
Yes.
But we've never owned the stock.
Yeah.
On a single stock where you're just actually rolling it. So in that example, if Roche just stayed at 265 and we kept doing the 260, and we got paid, you know, this $8-9 or Swiss francs, so, you know, 15% annualized rate of return, effectively, because we never do it at less than that, then you would just sit there forever getting 15% annualized rate of return on whatever capital you committed to that idea.
Yeah. So you like it at 260, you're interested in it at 265, you like it at 260, you love it at 250. So you're actually true to label as a value investor. You are literally buying it as it goes down, down, down.
Absolutely. We're no different to anybody else in that respect. So, you know, we've made the commitment at the 260, and let's say the results were poor. They actually had a new drug, a phase 3 trial that was relatively poorly received. As I said, it hasn't yielded the results that we expected. That sort of went to about 248. You know, we're in the situation where rather than doing 1%, you could do 1.5% at 240. Yes. So as it falls, obviously we're scaling in like any value manager. But the crucial thing is that this is an equity that we think is ultimately worth 400.
Yes.
And we're only doing it on these 25 to 35 stocks in the portfolio that we feel that we absolutely want to own.
Yes.
So the way that we often characterize it is that, you know, back to the insurance parlance, we're providing insurance on an event that we want to happen.
Yes.
We want to own Roche stock because it's worth 400.
And more volatility means potentially a greater chance for more income.
It does. There's 3 things that we benefit from.
Yes.
I mean, in terms of rising volatility. So first off, we get paid more for doing the same thing. So that income component goes up. But I'd want to emphasise that there's 2 others that quite often are not recognised as having as much value as they do. So let's say that Roche, when I was saying, let's say we thought it was worth 280.
Yes.
So it's trading at 260, or we could commit to do it at 260. We're not going to do it there because you have to have at least 20% absolute upside, right? If the stock was trading at 265 still, but volatility was 45, you might be able to commit to buy it at 245.
Yes.
So we're getting paid more at 245, but actually suddenly the range of stocks we can commit to buy goes up very quickly if volatility rises. And it means that the quality of the companies in the portfolio that we've committed our investors' capital to also can rise pretty quickly.
Yes.
So I think that's underappreciated. Definitely. Clearly the biggest single positive is that the income component goes up.
If I'm one of the listeners here, I'm going to be thinking, so why would someone buy that premium, that option that you're selling?
That's a great question.
Do we want to quickly touch on that?
I do. That's a great question. Thanks for asking that. I mean, listen, insurance is tremendously profitable across all insurance industries, right? And now the big picture is no one would provide insurance unless it was profitable.
Yes.
Right? But there's three reasons, particularly in equity markets, that it's profitable. And it's really behaviourally driven. And that's why actually it's stayed very, very consistent over a very long period of time. So the three things really are, in equity markets, people are always looking for a positive skew. That means they're growth investors, they're looking for the right-hand side. So they overpay for the left-hand side. They'll give that away. Yes. So they misprice that. But the two that are more intuitive to me and behaviourally driven are, we know losing $10 and making $10 has vastly different psychological impacts. Or it does on me anyway. And I think everybody else, right? So no one's outside of these things because that's why they're all behaviourally driven. And therefore, they will overpay you to take away that psychological distress of the losing money. Oh, at least I've limited how much I've lost because in the Roche example, I own it, but I'll buy a put because it might go from 265 because of this phase 3 data, which actually turned out to be right, which is good for us because we get to own Roche and we think it's 400, but they'll overpay us for that.
Yes.
And then the third key thing is really we know that people are very poor at dealing with uncertainty. Yes. Okay, so last year I went on holiday with the kids and Fernanda, my wife, and we went to New Zealand. I've never been there, but it's great. And I don't know, we were there for 10 days. Well, I paid, and I've travelled a lot in my professional life, but also personally, partly that's age, I guess. Yes. But it didn't, and I've never claimed travel insurance. It didn't stop me paying $285 for the travel insurance for the trip. So as I'm watching the kids go down whitewater rafting or on the trampoline, I don't think, how are we going to get out of here if they break a leg? So I'm no different. And in the equity market, it's exactly the same.
I feel the volatility is something that's here to stay. It feels like the markets are more volatile than ever. Mm-hmm. So for clients, managing that drawdown and being able to profit from people's panic rather than participate in it, I think it's something that's quite powerful and it's very unique to your fund. And from our clients' point of view, going into a tough economic environment, maybe going forward, do you see the same opportunities in terms of volatility? You'll be able to do the same strategy because you're not stock or sector specific. Mm-hmm. So what's next? The next 12 months, what does that look like from your perspective, and how will you manage the money in that?
Yeah, sure. So we won't run it any differently than we have for 19 years. We're fundamental bottom up. We're looking for mispriced securities, okay? We're just not paying for growth. So growth is a relatively poor forward factor. You made an assertion that, hey, the next decade might not be the same as the last decade. And I do think that that's a really important point. And it's difficult to then recognise that in a practical sense. What is going to be the crucial difference? You and I have joked before, the ancient Mesopotamians understood the difference between, the value of owning a piece of land and growing a cucumber. Now, in the global equity space or the equity market, that's the equivalent of the capital component of return and the income component of return. Now, over the very long term, the best developed market for capital growth has been the US.
Yes.
Only about 52% of the total return has come from the capital side in the US. So about 48 has come from income, okay? And that's by far and away the best capital growth market in global equities. So the last 10 years is actually relatively different. We have seen this through the 90s and through the tech boom, which obviously I was part of as well, where we've had about the highest component of return has come from the capital side over the last decade. And so one of the crucial things I take away, and I would impress on people that where you said, hey, the next 10 years may be different, I think it's very likely that you're going to at the least have a much more balanced return profile between the income component and the capital component. And in many instances, we've seen decades post what it's been like in the last decade, where the next decade, 100% of the return comes from income. Yeah. Okay, so I think that's probably the number one thing that I would think of in terms of going forward.
Is that the last 16 years since the global financial crisis, the Australian share market is at the same level it was then?
Yeah, absolutely.
So again, no capital growth at the market level, so they've been reliant solely on the income. And we've been saying that to clients a lot in our meetings of late, is if the last 10 years was characterised by 8% growth and maybe 2% income, the next 10 years might be more 5% growth, 5% income. So we can lower that growth assumption, but we can probably increase that income assumption. Based off interest rates now, we had the global financial crisis, record low interest rates for a long time. During COVID, they stayed lower. And now we've got a more, would we say now is a more normalised environment?
Well, it's normalised compared to kind of 3,000-year low interest rates at zero, I guess. Listen, there's a lot more things that have been similar than people have realised. So you're asking about the next 12 months. What I would say is that, you know, we're not in the business of forecasting at Talaria. Our crystal ball is no better than anybody else's. That's why we're ultimately value managers. But we are keen students of history. Yes. And what we have had, of course, is we've had we've had 13 interest rate cycles since the Second World War.
Yes. Okay,
and I'm really referencing the Federal Reserve here. So global is shorthand for that, for US, I guess, in that sense, or US is shorthand for global. And what you can see is that in every instances where we've had a rising interest rate environment, it's slowed the economy, it's slowed corporate profitability, and in the majority, 10 out of 13 times, it's led to a contraction in GDP. Okay? So at the very least then, what you need to recognise is one, monetary policy acts with a lag. So people feel like that's yesterday's story, but the reality is it's about 18 to 24 months between the first interest rate rise that feeds through into the global macro economy. Now we're only 19 months at the moment as we speak in November since the Federal Reserve raised interest rates for the first time. So we are going to continue to see a deceleration in the global economy. And I think the probability of a re-acceleration in corporate profitability over the next 12 to 18 months is the lowest probability. Doesn't mean it can't happen, but it's the lowest probability looking at that historical precedent since the Second World War. So what we've looked at then for our own interest is 18 months after the first interest rate rise, the subsequent 18 months, what's happened over the last 30 years in asset markets within equities. So different factors and what's done well and what hasn't done well. And what's interesting is that cheaper shares have done well in every instance of the rising interest rate environment 18 months after the first rise in the subsequent year and a half. They've outperformed by about 13% per annum.
Yes.
Okay. The second thing is that leveraged, so companies that carry a lot of debt have always done poorly. So I think a conservatively positioned portfolio in terms of companies that don't carry too much debt is important.
Makes sense. Yeah.
Exactly, and that because of the refinance, but also that bad things can happen, and if you've got debt, you know, that's got to come from somewhere, and it comes from the people who own the share, the equity. But the third key thing, which is really interesting, and it's happened 100% of the time, is that companies that are the fastest growing forecast earnings 2 years out have always underperformed as well.
Yes.
So what tends to happen is you get the first interest rate rise, and that starts to slow the economy, and equity investors start to pay a premium for things that they perceive can continue to grow. Okay? As growth slows, what can grow outside of the normal economic cycle? So there are things like consumer discretionary and obviously technology and so on. And what that means is that as you continue to decelerate, they've actually overpaid for that growth because everything's cyclical. You know, I mean, everything kind of is part of the world that we live in and is influenced by macro, you know, governments or businesses or individuals' desire to spend money or so on. And so what happens in that slowing growth environment, subsequently, actually, they suffer from not being able to deliver that growth. Yeah. So that's within the equity market. So make sure that you're not in equities that have much debt. Make sure that you're in things that are relatively cheap, so you haven't overpaid for the growth that actually ultimately is in aggregate disappointing. But the third key component that we looked at is that income typically always is at least 50, and in 3 instances 100% of the return.
Yes.
Just going back to your point. So I think the key thing is being able to know that the assets that you hold will continue to be able to generate income in the foreseeable future because you're not having to crystallise them to subsidise your lifestyle is crucial. You know, selling at the wrong moment, so sequencing risk. But take assurance that you've actually got the money that funds your lifestyle and requirements. So ultimately, you can go out there and be the person that you want to do day to day rather than worrying about your financial health because of the security of those income payments that are coming through. I think that's absolutely the place to focus now. I really do.
I feel that's been really the intention of us within our own investment committee is we don't see that the growth is going to be, hyperbolic like it was. Those days are to some extent gone. They will return because everything is cyclical. But right now it feels if I was a retiree, the responsible thing to do would be to really try and maximise my income. And if growth is there, that's great. But if it's not, it's not. So can you just do a little bit of, and I think you've touched on it already, so the dividends and franking credits in Australia are great. People are going to say, well, I can get 6% dividend or franking, maybe even a BHP recent example, someone like that, what they've done with dividends versus yours, just to sort of touch on that quickly again.
Yeah, absolutely. So clearly, and you talked about this, so we can invest everywhere in the world except Australia. Yes. But because of our interest in markets generally, more than 100% of the return in the Australian stock market since 1974 is reinvested dividends. So big picture, hey, a balance at the very least between income and capital is really important when you're thinking about total return, which you've ticked off. 2, hey, Australia's a pretty good market for that, because of the absolute yield is actually relatively high compared to global equities. So the global equity market would have a dividend yield currently of about 2.2, 2.3, compared to the Australian market that's 4.5 to 5. Yep. So Australia is an advantage market in that context. Then you get the franking credits. So where's the negative? Well, the negative is that they're very concentrated in a relatively small number of sectors. So you're taking on, financials, for example. Well, I've just talked about being levered and, bad things can happen in slowing economies. Well, banks ultimately have about 10 to 12 times leverage. That's the capital requirement. Small changes in asset values can have large changes in their balance sheets because they're so levered.
Silicon Valley Bank, as an example.
Yeah, for example, or GFC, etc., and all that good stuff. But every cycle has that in terms of bad loan cycle for the banks, and that can then crimp their ability to be able to pay dividends. So you've got that concentration risk in a couple of sectors that are the most cyclical. Particularly, we've talked about commodities and also financials, and that's where the majority of the Australian dividend payments in aggregate come from. Yes. Okay. So you're taking on a country risk in terms of Australia. Who knows what the regulatory environment will be? You're taking
if they remove franking credits, for example, which has been on an agenda a few times.
Yeah, exactly. Yep. Yeah, ultimately governments have made a lot of commitments that are hard to see how they can fund them, and funding them out of hard-won savings is something that history has said is a fairly first stop for most governments. Yes. Hadrian, when he came in, didn't he? They were basically bankrupt, the Roman Empire, and he sort of halved the amount of gold. So you'd been saving your gold coins under the bed, and then suddenly they're worth half as much as they were, and that's time immemorial that's happened. So I do think there's a big picture regulatory risk, but you've got that cyclical risk of being so exposed to 2 pretty heavily cyclical sectors. Yes. So, and then the third key thing is that it's really. Dividends are management's desire or ability to pay a dividend. Okay, and quite often they might have the ability, but when there's very large uncertainty, their desire to conserve cash and let's find out tomorrow what the world looks like means that they withhold dividends or they reduce them. Now, I think that's prudent from a management team, but it doesn't help you when that's a component of your budget for the caravan holiday.
Yes. Yep.
So the benefit of kind of our source of income, and we get some off dividends of the shares that we happen to own, we don't target that in any way, is that it's independent of that business cycle. It means that we don't have any sector or country concentration risk because this is the income that flows from our process is an outcome of the process rather than targeted. Yes. We're not saying, hey, we want to do 6% and therefore we start doing things with the capital that ain't great. Yes. Telstra's a good example of that, obviously. All our shares may not pay a dividend at all, and yet we would still consistently be able to generate that 7 to 8% income per annum that's distributable to our investors.
I think this year BHP reduced their dividend, so people had bought into it on the basis that it was going to be a high dividend, and then management cut it. So all of a sudden, those people that might have thought they were getting $10,000 in income get $6,000, and that impacts your real life.
Absolutely.
So, and I feel, we're seeing a lot of the boards the billboards now with the solicitors funds or the private credit funds on 8, 9, 10% guaranteed. But again, we talk about business cycle risk.
Yeah.
Do you want to put your 2 cents in on those kind of investments and where the risk is on that because they are so poorly regulated, that they might get away with it and clients might lose all their money? So can you touch on that?
Absolutely. First off, this is designed. The regulator wants a lot of this out of banking system lending. So this is an aim, and it's trying to push off the risk from the banking sector into the private sector. And that risk, as I said, in the banks is kind of asset write-downs and having to rebuild capital. But actually that risk is put into the private savings pool, which is about losing your money. Yes. All right. If you take a write-down on that, it's not like a bank who's got a very diversified pool of loans. You're talking about things that may have $1 billion private credit, but they might have 200 loans. Well, you're taking on a tremendous amount of potential credit risk is the first thing. I think the second thing is that everything, as we said, is cyclical. So nothing's outside of the business cycle. I mean, if you think about base rates, that's about 500 basis points over. That's really saying it's a high yield debt. I mean, that's comparative to what you can potentially get high yield. And the smartest people in high yield, actually every high yield manager is looking only at the recovery rate. So they're making default assumptions. Yes. Whereas what worries me is that, in private credit, actually it's very opaque. Because it's unregulated, but you don't really know what's being lent to. Yes. Okay. And then, so that's the second thing I'd say. And then the third thing is, it goes back to my previous comment. I think when you target investment outcomes in a strategy or a process, it's the second best way I've seen people lose money in my career. The first is where the illusion of liquidity is revealed as an illusion. So in the good times, everyone says, well, I don't need the money today. But when suddenly you forget that things can go offer only, and the price can be a lot lower than you think, and it can take a long time to liquidate that asset. So that's a concern for me. But when people are guaranteeing anything in investment outcomes in an uncertain world, and we're making decisions under uncertainty, as I said, then that would ultimately be a red flag to me.
We've seen a lot of rise in the value of index funds. As Warren Buffett likes to say, a rising tide lifts all boats. While everything was going up, index was doing really well. My personal view is that that's going to get challenged over the next 10 years more and more. I know that you are an active manager, but thoughts on that?
Yeah, listen, one of the things in terms of first point on the team, we deliberately are generalists, and there's a whole range of things that we've built into the process to try to limit as much as possible the behavioural biases that we can profit from by selling the puts, but equally that we're all plagued by because we're all human. Yes. Okay, we are absolutely collectively trying to come up with the right answer for our investors' money, rather than ever get into a situation of defending a position. Yeah. Right, and that's
a key point.
Yeah, it could be really different at different places. We are collectively trying to come up with the right decision. So before we invest in Roche, because we are making decisions under uncertainty, a lot of mistakes are made by the best in the business. Talking about Buffett, he's saying I'm getting 6 out of 10 right.
Yep.
Right. Now, if you got on an aircraft and they said, I'm delighted that Jenny's going to be the aircraft engineer today because she gets it right 999 times out of 1,000, you'd obviously get off and get on the bus. Whereas in active management, people are getting it wrong because of this decisions under uncertainty. So we always have an ante-mortem. So in the Roche, what's an ante-mortem? We're playing forward and say, hey, we think it's worth 400, but if in 3.5 years' time, our average holding period, this is one of the ones that hasn't worked out. What does that look like? And we're doing that for 2 reasons. Firstly, so that we try to set up a whole series of effective markers along the way to identify earlier things that actually aren't on track with our investment kind of idea of what normalised earnings power is going to be, so that we can cut it and move on, so limit the loss potentially, or put the capital into a better idea. But the main thing is you anchor to the idea that you can have a range of outcomes in terms of that defending of a position. I mean, so you go in open-minded to the fact that, hey, things are going to be different looking on this investment in 1.5 years' time. Now, sometimes they're way better, but sometimes they're worse. And so we just want to be alive to that fact at all times, because we are fiduciaries of other people's money. In terms of active versus passive, like you say, we're an active manager. We're truly active. We have a whole range of stocks and regions and so on that look different. I guess, to the large global benchmarks, certainly. I'm a little worried personally about passive because it's sort of the python that's eating itself now. So it's only ever had inflows. And what's happened, of course, is that it's become a bigger and bigger part of the savings pool, equity savings pool. And therefore, concentration has become bigger and bigger and bigger.
Yes.
Because there's more ETFs than single stocks now.
Wow. So there's more exchange-traded funds than they can actually invest in stocks.
Exactly. So if you look at something like Apple, it will be on the ESG fund, the growth fund, the emerging market fund, the developed market fund, the consumer fund, the dividend fund, the quality fund. It's in everything. And why is that? Because it's the biggest company in the world.
Yes.
And they're trying to make sure that they're not limited. That would be my cynical side. And certainly, so we're seeing, at the moment, every dollar of passive, we know that the magnificent, or the largest 5 or 6 companies in the US have about 30% of the entire market share.
Yes.
Okay? So 30 cents in the dollar are going to those. But I reckon it's more in terms of passive.
Yes.
Because they're in every ETF.
Yes. Just
to be able to facilitate growth. Now, what happens in a place where, as a value manager, something like Microsoft for us is a great business, hasn't been on the screen for a long time. We would, at the right price, of course, be interested in any business. But that's a long way down from where it is today, is my intuition. Yes. So what happens if passive just went flat? There wasn't inflows or outflows as demographics, as people start, taking money out as much as putting it in. Well, what happens then? And one way that we've talked around the desk about the pandemic, remember we had that really sharp sell-off in March 2020, is that those 2 weeks were the only 2 weeks ever that we haven't seen inflows into ETFs.
Yes.
And the market went down about a third in about 9 sessions. Now, clearly there's a pandemic, yes, but was that also exacerbated by the fact that you suddenly didn't have any just endless passive flow holding up asset prices in some particular securities?
So with an aging population, less money, more money coming out of the system, it's got to come out of equities and cash and fixed interest, means that it won't keep the workers can't support the retirees.
Yeah.
So we're in a decumulation phase, money coming out of ETFs.
Yeah, so that's one thing that worries me. The second thing is that, the rise of this has been in one environment, and yet the assets that people might want in aggregate in the next 10 years might be different.
Yes.
I'm not forecasting that at all, but let's say, hey, there's pretty credible reasons to think that inflation over the next 10 years could be higher than it's been the last 10 years. How high? Discuss, but why is that? Well, we've got decarbonisation.
Yes.
So that's an expensive process. A lot of money is being put into that. Obviously, we've got demographics. I mean, you had 350 million people enter the workforce from Eastern Europe over the last 20 years. You obviously had China come in.
Yes.
Well, those 2 things are done.
Yes.
So labour is an acute shortage really now, which is kind of incredible to me. Very, very quickly in all industries. So clearly that's inflation, and we're seeing that in wage inflation at the moment. And the third key thing is because of geopolitics, 20 years of globalisation, we're seeing deglobalisation and changing of supply chains. Well, that costs money. So all of those things on the margin are more inflationary. Okay. If it is more inflationary, even if you think the odds of a slightly more inflationary environment are higher, then maybe my asset mix has to be higher. When in an equity market, that isn't the current stocks that make up the majority of the market cap.
Yes.
I mean, an amazing statistic is about, just on the S&P again, just because the statistics are good, about half of the S&P 500, 0.5%, is in materials, mining, gold, copper, things that might do better in an inflation environment. Now, clearly that's different in Australia. But that's 0.5%.
Yes.
And let's say you said, well, I'm going to continue to save in a S&P 500 ETF, and it turns out to be an inflationary environment. Well, I have a very, all the large things are independent of that. They've risen in a different environment. So that's the second thing. The third key thing is, as a value manager, I absolutely can't abide by just actually buying things that are where I'm absolutely price insensitive.
Yes.
And going back to the concentration, 30 cents in every dollar is absolutely value insensitive to the price of Apple, Nvidia, Microsoft. They would be buying that today at any price. Even if it doubles from here, or doubles again.
Yeah.
But how can you actually have a strategy where price and what you're asked to pay matters nothing? I just don't
And the greatest
philosophically believe that.
Well, and the greatest investors of all time have always been value investors.
Yeah.
So, you know,
Well, everyone's conscious of price who's
Yes.
in any way bringing an acumen or an active
Yes.
capacity, whereas actually the majority of flows now into equity markets are ultimately from absolutely price insensitive buyers.
Yes. Which might give opportunity to the active managers.
It does. Listen, we came into the year with we've only got about 20% of the portfolio, a little over 20% in direct North American shares, and it makes up about 72% of the global market capitalisation, just to put that in context. But we came into the start of the year with about 17% of the portfolio, as it happens in 5 Japanese securities.
Yes.
Now, 5 years ago, we would have had 1%. Well, people have a look at the S&P, year to date, it's been a good performer. Equally market cap, if equal weighted all the stocks, it's broadly not up very much at all. Whereas Japan's up over 20%.
Yep. So if we took out those 7 of the US market, the US market's done nothing. That Magnificent 7, take them out.
Broadly nothing.
493 haven't done much.
Yeah.
Although people think it's done well because of the heavy lifting of those 7. But Japan, who no one's looked at, has done 20, and most people wouldn't even know the Japanese share market has done that.
No, absolutely.
And that was just because there were stocks there that you found that were undervalued.
Yep.
And you're able to take advantage of that. Didn't matter where they were, you just found undervalued stocks.
We did, yeah. Strong balance sheets, consistently underpriced cash flows, and I guess, our philosophy would be good things can happen to cheap shares.
That's good philosophy.
I would say, like, that's on the positive side, but before all else, we're a risk manager, Hugh. I would say that. Like, we spend all our time, first off, rule number 1, don't lose money. Rule number 2, never forget rule number 1. But we spend all our time thinking about that. Listen, the right-hand side of good things sort of happening on total returns and capital growth and companies sort of going up in price and valuation tend to stem from making sure that you've taken care of the risk management side first. And then it gives you an open kind of screen for things to do better than you may have expected.
Yes. I do like that as an approach. And even if it's not doing what you expect, you're getting paid income anyway.
Absolutely.
So you're still okay. Quick talk to the guys on the geopolitical tension you touched on. How is what's going on with Hamas, what's going on with China-US tensions, all of this, how will that impact your portfolio?
Well, it'll make me personally just a little bit sadder every day. It's just absolutely miserable. Obviously, a lot of the people who've got nothing to say about anything who are just sort of getting killed or being forced to suffer. So that'll make the portfolio a little less joyful every day. In terms of the process itself, absolutely nothing. I think in the aggregate from a risk management point of view, we are certainly conscious about the overall shape of the portfolio, and that really comes down to sizing of positions here. Yeah. So that doesn't influence about what stocks are good value or bad value, but we are in aggregate very conscious about the risks we're exposed to from a macro point of view from the portfolio. So we run a whole range of screens and dashboards that sort of inform us about the things that we may be unwittingly exposed to. So, we could have 5 great ideas and then find out that you have a very strong view on the copper price or some exchange rate. And you're like, well, we never really thought about that. Yes. So we've obviously got to be fairly aware of that. And that would influence the sizing, not the individual stocks. And then we have a look at the factor exposure. And that's really about, there's about 29 individual security factors. So we're talking about different valuation metrics of the portfolio, but also the overall opportunity set, things like beta, things like consistency of sales delivery and debt and leverage and so on. So that would impact that as well, because clearly there are places in the world where capital is subjected to a much wider range of potential outcomes. I mean, you touched on China there. Clearly, that's an area that, the rule of law doesn't really count for anything. It's the rule of the CCP. Well, that has to impact what capital you'd be prepared to ever put at risk there.
Yes.
I just don't see how you wouldn't take that into account. In terms of the Middle East and so on, the sad reality is through our framework of a normalised returns, unfortunately, there's been pretty awful things happening in a lot of parts of the world for a long period of time, on and off, and it's just that probably doesn't impact the idea of the earnings cycle. But in terms of strategically, I think it's just going to drive companies to really diversify their sources of supply
Yes.
and diversify their regions of production capacity.
Yes. Deglobalization.
Is real.
Yeah.
Yeah, I mean, it's really interesting. So the best performing stock in the fund this year is a Mexican retailer, US listing. Fantastic business, up about 52%, I think, year to date, or total return, or 50 odd. And then, you know, they're growing great. They run a whole series of convenience stores there. Funnily enough, the Gates Foundation sits on the board. I read the other day from listening to their conference call that, you know, Mexico is now the biggest trading partner with the US. You know, that's happened pretty fast.
Just for our clients out there, are there any last words that you'd like to say for them?
I think a key thing I'd probably say is, one, listen, what we do on behalf of people like yourselves is a really serious game. And what I mean by that is that we're assessing odds and probabilities, okay? And we work very, very hard to make sure that we always constantly skew them on your behalf, okay? Because that's all you can do about the future, which is inherently uncertain. I think the second key thing, Hugh, probably worth reiterating, the benefits of the way that we manage your and other clients' money is that we have strong, stable, and differentiated sources of income. We have a defensive portfolio that structurally loses less when the market goes down, okay, through a 19-year track record. And we have a much greater certainty of outcome because of these contracted kind of rates of return that we get from our implementation process.
Yes.
But we take it really seriously. It's a lot of fun, as you know.
Yes.
It's absolutely our life. We're really privileged to do it, but we are working absolutely every day on behalf of clients as a fiduciary of their hard-won savings. Yep.
I was going to add that every time we've talked to Hugh and the team at Talaria, they always go to this point of being a fiduciary and really acting in our clients' best interests. And through our relationship over the past 24 months, we've definitely felt that in how you talk about our clients and you talk about how to build the portfolios for them. So the goal of this webinar is that you guys can get greater peace of mind with one of the managers, a key component in your portfolio. It's very different interviewing someone who also has the name Hugh, but we've worked
Doesn't
through
happen.
that. No.
Have we?
That's Hugh Grant and Hugh Jackman, so we're in good company. So Hugh Selby-Smith, thank you very much.
Hugh, I really appreciate it. Thank you. Thanks.
Thank you. Bye.